Welcome back. Here with us on Urban Debate on Mirror Now. India's economy saw a growth of 8.7% in 2021-22, while in the January to March quarter, the growth was 4.1%, better than what most economists had expected. Given the challenges like Russia-Ukraine crisis, Omicron-led third wave, and rising inflation. Now, 8.7% GDP for the full year is above what we saw before the pandemic. So has the economy now come out of the woods is the big question that we will be discussing on Urban Debate this evening. While the Omicron variant of the coronavirus has hurt growth, India has managed to keep momentum intact. This was the first reaction of India's chief economic advisor after the GDP data came out. And to discuss these GDP numbers, I have with me my guest joining us. We have Mr. Subhash Chandra Garg, former Finance Secretary of India, live with us. We also are joined by Dr. M. Govinda Rao, Chief Economic Advisor, Brickwork Ratings. Good evening to both of you, gentlemen. Thank you for joining us here on Urban Debate on Mirror Now this evening. Mr. Subhash Chandra Garg, your first reaction to the growth numbers that we got today, better, in line, or lower than expectations?
Heena, this growth of 8.7% is in line with the expectations of most economists and also probably the government. It's a good growth. 8.7 is a good number, but the good news stops there. You just displayed that chart. The growth in third and fourth quarter was only 5.4 and 4.1%. An economy which is growing at this rate, even when the previous year, when everything has more or less normalized in the third and fourth quarter, and the growth was small, and generating this kind of growth in third and fourth quarter, to my mind, is quite a serious thing. We should be careful about how things are going. I am also, I would like to link what the RBI's own assessment says about the growth in 22-23. And in that also, the third and fourth quarter growth is projected only at 4.5% and 4%. Now, if this kind of growth for 3 years continuously, in the second half, we are registering the growth of only about 3.5% or so, I think it's quite a serious thing to do, to know. The one more thing I would like to note at the beginning is that while we have registered 8.7% this year, 21-22, it comes on the back of 6.6% minus growth, contraction the year before, and a very low growth of 3.1% in 19-20. So if you take 3 years together, 1 year of the pre-pandemic and one pandemic and one post-pandemic year, so to say, we have grown only by 5% or so in 3 years, giving us a growth rate of only 1.7%. And if you relate it to the growth of last pre-pandemic 2 years, that growth is also only 1.5% in total. In 2 years, 1.5% growth in 2 years. So I think these numbers are quite sobering. We should take and make a very deep analysis and look for right kind of solutions to put India back on a very high growth path. Thank you.
Interesting. And we'll, of course, be talking about those solutions as well. And to decode these complicated numbers, which tell a lot about India's economic recovery, where it is right now, we have two bright minds on the show today. Dr. Govinda Rao, let me ask you also the question that I asked Mr. Garg earlier. In line, better, or lower than expectations, the numbers today?
Well, considering the various facts that have appeared in the last few, in the whole of 2021, 22. In fact, I was expecting a lower growth than that was presented. 8.7%. Certainly it's a sobering thing. I mean, considering But then the fact of the matter is that there have been several disruptions. It's not just the pandemic. Of course, the effect of war is just to begin, it has just begun. But more than anything else, there have been lots of other disruptions, particularly in the manufacturing sector. After the chip shortage, in fact, quite a lot of the organized manufacturing sector has had to face a lot of difficulties. And even the government expenditure in the last quarter, particularly capital expenditure, has not been very good. There is a certain trend that is seen that is both in 2020, 21 and 21, 22. There is a, the first two quarters, you have the base effect, so the growth rates were high. But then as, in the third and fourth quarters, the growth rate actually decelerates. There is a certain trend. But possibly we can't still call it a trend, but there are lots of disruptions and changes that have been happening in the economy. One of the things that is giving some satisfaction is that the investment, if you look at the investment growth, things have not been too bad. In fact, gross fixed capital formation this year, for example, in 2021-22, if you look at the growth rate over the previous year, it comes to somewhere about 15.8%. But I mean, again, one doesn't have to take it to a very, one has to be realistic, because as compared to 2019-20, growth rate is just about 3.7%. But so, in other words, the investment is in a sense holding out, but I do not know whether, with all the disturbance that is happening, whether the promised capital investment by the government will happen, because there are lots of expenditure increases that will happen because of underestimation of subsidies and DA payments and various other things because of the inflation that happened. But fact of the matter is, as per the expectations, we did expect that the growth would be somewhere about 8.5, 8.6%. 8.7% is as per expectations. But that expectation itself is a very moderate expectation. I mean, if you really look at the overall situation, I don't think the economy has done all that well. I mean, we are still in a deep slump.
Okay, the economy hasn't done all that well. The expectation only was moderate. Those are interesting comments. But Mr. Subhash Chandra Garg, let me play devil's advocate here. Now, if you look at the January to March quarter, that was the time we had Omicron-led third wave. The war between Russia and Ukraine began. Apart from this, fuel prices started rising, inflation started going up as well. So despite the challenges, which were unprecedented challenges, if I may use that word for them, we've managed to clock 4.1%. And, most people had started downgrading India's growth forecast for that year. Some, of course, felt that India might not even be able to cross 7.5%. For example, the Asian Development Bank's forecast was 7.5% for India.
So it's true that Omicron wave 3 was present in the quarter 4. But please remember the quarter 1 of 21-22, when India was actually hit by the worst worst COVID wave. And in that quarter, we grew by 20%. Therefore, there is no real relationship between the COVID waves and the growth. It depends upon how do you deal with it. Unlike the wave 1, when there was a large lockdown, in wave 2 and wave 3, the government decided rightly that there was no lockdown imposed. And therefore, I don't see the the Omicron wave 3 impacting at all the growth in production in quarter 4. In fact, if you look at the numbers of the tax growth, you look at the number of corporate profits growth, and you also look at the manufacturing growth. All this suggests that the quarter 4, from the manufacturing point of view and the tax growth point of view, was very, very buoyant. The two other reasons which you cited, one about this Russia-Ukraine war, that actually started in the month of March, late March, and that impact is also not there in this quarter's growth. Likewise, the inflation doesn't really impact the growth as much. In fact, our nominal growth is very high at 19%, which is reflected in the tax growth and all. So 4.1, I don't think we should look for any excuses. This actually represents a very serious deceleration of momentum in the growth. Why is RBI anticipating the growth of only 4% in quarter 4 of 22-23, the year we are going? I don't think they anticipate any wave or anything else, or it's because of inflation. It's, I think, serious loss of momentum of growth in the economy. We will need to address the issues which are really impacting the growth, not look for the excuses like the inflation or Russia war or the Omicron.
Okay, interesting. Dr. Rao, so what are the issues that the government should now be extremely concerned about? We've heard the chief economic advisor today saying that, Q4 numbers are better than estimated. He's also said that the risk of stagflation in India is quite low compared to other countries. When we hear government, the chief economic advisor, compare India's situation with other countries and tell us we are doing much better, are we then trying to, in a way, not look at the real problems and wanting people to believe that things are very good, we are out of the woods, but actually we need to look at our problems too?
Well, I mean, I'm not surprised that the chief economic advisor will say that. Obviously, if he says that we are in a panic situation, that's not going to help matters in any case. And he has to defend, and he has to say that things are pretty good, the fundamentals are good. And these are the usual words that the government officials will use. And
then why is Mr. Garg saying that we are not really addressing the root cause here? The numbers are actually representing a serious deceleration of momentum.
Let me talk about that.
Or are you trying to say that when he was in the government, he would have also said what the CA said today?
I am sure Subhash Garg would have said the same thing when he was in the government.
No, I must say, it's always necessary to defend the government when you are in the government, but you should not sound
it's a matter of
credibility.
It's a matter
Otherwise,
of dignity, but let me come to the
That was on a lighter note, Mr. Garg. Yes.
Let me come to the real thing. You see, I mean, if you really look at where the deceleration has taken place, mainly it's in the construction sector, and that's a worrisome thing because that's an employment-intensive sector. The manufacturing sector has gone reasonably well, but it would have done much better if you did not have the supply side problems, whether it is chips or whether it is power or whether it is raw material availability and the like. And then obviously, with China shutting out a lot of your imports, from China, your manufacturing sector depends hugely on the imports from China. But in spite of that, it has grown, at about 6% or somewhere about that. Now, but then the growth of and even the financial sector has not grown extremely well, just a little over 4%, which is not a pleasant thing. Omicron did not play the havoc as the other earlier sort of variant had. And 20% growth in this thing is mainly the base effect. I mean, let us see that, because lockdown was complete at the time, and it was, there is nothing to be elated about the 20% growth that we are talking about. It was mainly the base effect. Now, as I mentioned earlier, the lower growth is a combination of many factors, because in the fourth quarter in the last year had recovered reasonably well. So obviously you don't have the benefit of so much of a base effect, and then 8 point. I don't think anybody expected the growth to be more than. In fact, you see, my own estimate for the fourth quarter growth was just about anything between 3.7 to 4%. So I mean, I don't think one should be alarmed about it. But whether we should keep quiet on that, no, we need to do a lot more of things. In fact, the fact that the construction sector is showing a slowdown, I think there are immediate things that need to be done. Whether, first there is an availability, whether it is cement or steel or any of these, and that will also show up in the first quarter figures for the next year, that is the current year. Now, if you tax cement, steel, and everything under this at the rate of 28% GST, and raw material prices have been going huge, very high. And in this particular environment, possibly there is a case for really looking at it, and the revenues have been increasing, and your expectation is also not, your projections are also not very high. And again, this multiple rates, this thing, I think there is no case for having 28% at all in the GST system. I mean, if you want to have really, I mean, even if you see the automobiles, cars, the downstream industries for, it's a very highly employment intensive industry. I mean, we say that only rich people buy the car, but then it's the poor man who gets a job. So one has to look at it in much more holistic manner. And one has to basically, monetary policy, in fact, you see, they had, they were pumping in the economy, pumping money into the economy, and then obviously the liquidity was very high. So now that's going to happen. Now also you see that if you see the wholesale price index is approaching 15%, month on month. Now, I mean, in this particular, the last month, basically means that much of the manufacturing sector has to take a very high cost raw materials, and then many supply disruptions, and then various other factors. Now, particularly,
so deceleration in construction is something that the government should really focus on. I want to give you last 10 seconds, Mr. Garg. 2-3 pain points, according to you, the government should address.
Government should address, because the government
yes, sir, Dr. Rao, quickly, very quickly.
In the fourth quarter, government capital expenditure in the fourth quarter was low, and I mean, it didn't grow well, and obviously that has its impact on the construction sector as well. So obviously you need to really...
yes, so you've identified one pain point, sir, that's construction. 10 seconds to Mr. Garg, closing comments, 1 or 2 pain points that you can identify looking at the numbers that we've got today and the data we've got in the last 1 month that the government should now address to get economy back on that high growth path without a lower base.
I think very quickly, number one, we should rationalize subsidies. They're hurting our growth. There's too much of expansion of subsidies. Second, we should not deal with the exports the way we are dealing with. Exports of wheat, exports of steel, and many other things are affected adversely. That will pain us in times to come. Infrastructure and construction, as Mr. Rao said, it requires reform for private sector investment to come in. There is no private sector investment in infrastructure practically, except data centers and all. And finally, I think we will need to do a lot of privatization of this inefficient public sector entities, including in the power sector. So very quickly, these are the 4 suggestions from my side.
All right. Thank you very much, gentlemen. Appreciate both of you for joining us here on Urban Debate on Mirror Now this evening and decoding the GDP numbers for our viewers. Thank you for joining us. With this,
Thank
it's a
you.
wrap. Thank you for staying with us here on Urban Debate. Heading into a short break. Griha joins you next.